This is LONGWave, featuring technical analysis and market analytics by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on his analysis, which he feels to be accurate and unbiased. Participants may or may not hold positions in any securities that are discussed. You should always consult a registered investment advisor before making any investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Tuesday, August the 13th, 2013. I'm Gord Long at GordonTLong.com. As usual, I have a lot of charts for us to go through this morning, so therefore I will pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your slide viewer to full screen viewing, or you will not be able to see some of the detail I'll be discussing. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscribers report so as not to confuse them with the drivers that are operating behind them. Drivers in the long term are primarily the fundamentals. In the intermediate term, risk. And in the short term, confidence and sentiment. In this regard, I want to talk today about, first, the clear signals we are now seeing emerge regarding a potential looming U.S. recession. Second, Q2 earnings results and the earnings conference guidance that is being issued. Third, current equity valuations. And fourth, the mounting profit margin pressures, which we've talked about previously, but we're seeing more of now during these conference calls. The European recession is now in its seventh quarter and is longer than the 2008 recession, which was 5 quarters. The EU is 25% of global GDP, and as you would expect, the protracted recession is having a tremendous impact around the world. I just released a video entitled China's Slowdown Crippling Asia, with China expert Bert Dohmen of the China Boom Bust Analyst. You will see in that video the seriousness of the waves washing ashore across Asia. I encourage you to listen to it. It is posted on our macro analytics page. Even the perennial positive Bloomberg Orange Book, covering U.S. earnings and conference calls, is now sounding bearish about the U.S. economy. To me, the nominal GDP, that is, removing the manipulated deflator, tells the real story. The current levels normally warn of pending recession conditions. As an aside, it also suggests that the politically manipulated deflator should presently approximate 5%. Similar in distortion to John Williams' shadow stats numbers, which suggest that the true CPI is itself well north of 9%. My macroanalytics co-host, Charles Hugh Smith of Two Minds, recently wrote that every time real personal income goes negative, a recession occurs. Now that personal income is falling, a recession is baked in. The long-term chart of real personal income he cites highlights a strong correlation between falling real incomes and recession. This makes sense. If real income is declining, households have less income to spend and less income to leverage more debt. Note that real personal income is per capita, per person. That government transfer payments, that's checks from social programs such as welfare, social security, etc., are excluded. Charles also highlights that there are two noteworthy points in this particular chart. One is that the real personal income has been negative for the past 5 years, with one tax-related spike in late 2012, as those who could do so reported income in 2012 rather than 2013 to take advantage of the lower tax rate that expired in 2012. The second point is that every time the black line, the 6-month annualized rate of change of real personal income, fell below 0%, that is, went negative, a recession occurred. An important caveat is that the weak 6-month annualized comparison is against the spike in income at the end of 2012. Still, the year-over-year and smooth 6-month annualized rates were already falling below the historic recession threshold in late summer 2012 and again in winter-spring this year. A similar pattern and trajectory occurred after recessions had begun, as per the National Bureau of Economic Research, the NBER. August to September 2008, June to July 2001, October to November 1990, February and March 1982. It goes on with other dates. Of course, further back, the recessionary implications are bullish for more bank printing for their balance sheets and offshore equity index futures accounts based on this. In the most current Triggers webzine, I talked about watching term structures for clear recession signs. Credit always warns of pending crises long before multiple Hindenburg warnings, which, by the way, we now have multiple recordings of. Fixed income investors might have overreached to the prospective shift in U.S. central bank policy. The Fed has confirmed that highly accommodative policy will remain well past the point when unemployment reaches 6.5%. It will continue to pressure long-term rates lower by purchasing long-term assets until a sustainable recovery is achieved. Despite this, the 10-year Treasury yield has jumped more than 90 basis points since May 2nd. Yields on the 10-year at about 2.6% doesn't really signal distress. A return to more growth-friendly levels is both desirable and likely in the long term. Investors are rationally demanding higher returns for holding onto longer maturity bonds. Disinflation is moving through the economy. During the current down cycle, the Fed has not only pushed the short-term rates to zero, its asset purchase program has arguably pressured long-term rates to historical low levels, as this chart shows. This has helped to push the yield curve slope lower from its late 2009 peak. Interestingly, the term premium for holding 10-year bonds has turned upwards during the past 6 months, based on estimates from the Fed's deconstructed 10-year nominal yield. The term premium appears to have been its lowest at the height of the last two asset bubbles, the tech bubble in the late 1990s and the housing financial bubble in late 2006, when investors were most willing to take on additional risk. Conversely, when bubbles burst, investors appear to demand a larger risk premium as the safe haven demand for cash or short-term securities took hold. True to form, the term premium began to shrink again in post-crisis era and then became negative as the Fed's resolve to keep short-term interest rates extremely low for an extremely long period became apparent. A turn upward in the estimated term premium presents a quandary for monetary authority as they grapple with the liquidity traps and fiscal restraint that has squashed developed market economies. Household and corporations clearly prefer to sit on cash. Higher rates at this point, unless growth accelerates well beyond the long-term trend of 2.5%, would make investments even less likely. Although this has not been the first time that the bond market has sold off after the financial crisis, monetary policy has dictated that fixed income investment be a one-way trade. After 5 years of distressing news in the advanced economies, recent market activity could be construed as a positive sign for the health of the U.S. economy. The Fed has made it perfectly clear that it is willing to step up asset purchases if economic growth were to falter. In addition, civil turmoil in Brazil, Turkey, and hints of a banking crisis in China have potential to increase the safe haven demand for U.S. Treasuries once again. Wall Street has played a one-note tune for 3 months now, focused almost exclusively on the question of when the Federal Reserve will begin to taper its bond purchases. But while the market has turned on this question since May, it is actually 6 months since the first hint that the Fed was shifting its thinking on quantitative easing and that there might be more to the taper question than monthly swings in the economic data. Fed Jeremy Stein's February the 7th speech on overheating in credit markets signaled that officials were thinking seriously about the potential financial ill effects of quantitative easing, in a theme that was taken up by Chairman Bernanke 3 months later. It looked an important speech then. It looks seminal now. In it, Professor Stein highlighted the dangers to financial stability as investors reach to earn a little more yield in the ultra-low interest rate environment engineered by the Fed. He ran through a list of indicators where one may spot high-risk practices building up. Worth repeating here as we look at whether there's a U.S. recession ahead, which will come out of monetary policy shifts and just the nature of the magnitude of the ongoing slowdown that we're seeing, and the fact of these problems in Europe and problems in Asia washing ashore here in the United States. The first thing to say is that the months of May and June, when investors got used to the idea that Fed tapering will begin this year, took some of the air out of the junk bond and leveraged loans, but not nearly as much as one may imagine. One of Prof. Stein's insights was that policymakers must dig beyond headline numbers such as credit spreads if they want to see overheating before it is too late. Investors reach for yield by taking on risk in ways that are deliberately harder to measure by accepting fewer investor protections. For example, all four of his non-traditional indicators are now flashing warning lights. Data from Lipper and S&P Capital IQ shows this. Payment in kind or PIK notes. This year's issue of payment in kind notes, which allow borrowers to put up cash interest payments, is close to passing the total for the whole of 2012, having had the biggest month this year in July. Issuance of the Covenant Light hit an all-time record in February, but even through recent turbulence, it has remained elevated at monthly levels that were typical in the first half of 2007. The use of borrowing simply to pay private equity shareholders dividends, what they call div recaps, doubled in the second quarter from the first. July was slow, but there are $8 billion of deals slated for August, which will be at least the second highest month this year. LBO leverage. The leverage in large buyout deals in July was 5.9 times the highest since 2007. There's still a wall of money chasing the higher yields from junk bonds and leveraged loans. Leveraged loan funds just recorded their 59th successive week of inflows. There certainly were significant outflows from high-yield bonds in the several weeks when tapering fears were at their height, and Morningstar pegged the total assets in high-yield mutual and exchange-traded funds at $340 billion at the end of June, down 7% from the end of the previous quarter, but this is still twice as much as 6 years earlier. The vast expansion of ETFs and mortgage real estate investment trusts has changed financial markets in ways that are yet to be tested. Mortgage REITs in particular, which borrow in short-term markets to fund investments in government-backed mortgage securities, have had a taste of distress. Many have fallen by a quarter in market capitalization as those securities declined in value since May. REIT's earnings season is only recently underway, but it seems clear that they have been slimming down their portfolios, potentially taking out some of the risks that Professor Stein identified in that sector. Another risk, though, seems only likely to build. New derivatives trading rules and bank capitalization requirements for increasing demand for pristine capital, that is, treasuries and the like, for short-term lending, but these rules are only now being rolled out by regulators. There is much, in other words, for financial stability hawks to worry about. Even if the economic doves use the latest payroll data to argue for a delay to tapering, the evidence from the credit markets and from high yield and leveraged loan sectors in particular is that risk-taking may be more widespread even than it was when Professor Stein raised his early warnings in February. Lance Roberts of Street Talk Live has recently put out a number of great charts I wanted to share with you. I have Lance scheduled in an upcoming macro analytics session to discuss his analysis regarding a potential U.S. recession. Lance has been very vocal since the beginning of June that now is a great time to be adding bonds to portfolios. As subscribers know, my work on financial repression suggests we have more to go on shrinking bond yields, and will likely see the 10-year U.S. Treasury below 1% before the Fed has done everything it can through monetary policy to keep the U.S. debt funded. Never forget that this is what is really at play here, financing the U.S. debt. There are several fundamental reasons for Lance's belief that the recent rise in interest rates was more related to short-term liquidation cycle rather than an actual shift in global economic sentiment. Let me list the 8 reasons that he spells out specifically. 1. Domestic economic strength remains very weak, growing at just 1.8% annually since 2000. 2. 4 years into the current recovery, the economy has already passed the average length of most growth cycles. Interest rates fall during down cycles. 3. Geopolitical unrest makes U.S. Treasuries an attractive safe haven for foreign capital. 4. Global economic weakness, that is the China, Eurozone, and Japan, will likely drive buying of U.S. Treasuries. 5. Upcoming debt ceiling and budget debate in September is likely to drive inflows into the safety of bonds, similar to what we saw in 2011. 6. If the Federal Reserve begins to extract liquidity by slowing bond purchases, financial markets are likely to come under selling pressure, pushing money flows from equities into bonds. 7. Declining rates of inflation, which are representative of economic weakness. Ultra-low interest rate policies by the Fed will continue to push investors to seek yield over cash, and the recent rise in rates makes bond yields much more attractive. As shown in this chart, the driving force behind the long-term decline in interest rates has been the ongoing slide in both economic activity and inflationary pressures. Interest rates track the direction and trend of economic activity, as does inflation. Less demand in the economy leads to decline in prices, that is deflation, and interest rates. There are 2 important things to take away from the chart. 1, each time interest rates have spiked, it has led to a peak in economic activity. Economic growth has peaked for the current economic cycle, which has led to subsequent decline in inflationary pressures. Secondly, most of the commentary surrounding the reason that rates are on track to go higher is based on similar spikes seen in 1994. First, that spike in rates led to a sharp slowdown in economic activity, and rates quickly fell. Secondly, the economy was in the midst of a secular growth cycle due to an internet financial boom, which currently does not exist. On a Fox interview, Lance stated that interest rates are now 4 standard deviations above their long-term moving average. This chart is the technical reason as to why specifically he thinks now is the time to start actually acquiring bonds. Again, you can argue the fundamental story, depending on how you want to selectively build your economic case. However, it is difficult to argue with 35 years of interest rate history. This chart shows the 10-year Treasury rate on a weekly basis with bands set at 4 standard deviations above and below the 50-week moving average. The green shaded area is the current downtrend that has remained intact post the internet rate spikes in the late 70s. What is important to notice is that there has been only a few times in history that rates have gotten to 4 standard deviations above the long-term moving average. Every single time, as noted by the vertical and red dashed lines, such extreme movements in rates have been a peak in rates for the intermediate term. Most recently, these extreme spikes were witnessed prior to the recession following the technology bubble in 2000 and the housing bubble financial crisis in 2008. The blue shaded area at the bottom of the chart shows the current range of interest rates that are likely to occur given the context of the downtrend. The peak of that range is 3% on the 10-year Treasury, and the bottom of that downtrend would suggest rates on the 10-year during the next recession to fall below my current estimates of 1%. This is also where my long-term targets have been indicating for some time now. Lance Roberts further writes, there is scant evidence that the economy is entering into a growth mode, even after the recent data manipulation by the Bureau of Economic Analysis to artificially inflate the economic data by $500 billion through the addition of pension deficits and R&D expenses. The annual growth rate of the economy remained below 2% for the 3rd straight quarter. Historically, such events have only been witnessed prior to the onset of economic recessions, not expansions. I have been talking about collateral contagion for over 2 years now. Recently has been getting a lot more attention. First, it was the TBAC's May presentation, availability of high-quality collateral, piggybacking on reasoning presented previously by Credit Suisse. Then J.P. Morgan's resident flow and liquidity expert Nicholas Pranduzuluku, I'm sure I pronounced that wrong, rang the bell on regulatory changes to shadow banking and how they would impact the repo market and collateral availability and transformations in an adverse fashion. Now it is the turn of Barclays' own repo chief, Joseph Abate, to highlight a topic discussed since 2009, the ongoing contraction in quality collateral as a result of transformations in shadow banking and the Fed's extraction of quality collateral from traditional quality liquidity conduits, i.e. QE monetization of bonds. I quote, several recent regulatory proposals will increase the pressure on banks to reduce assets that carry low risk weights. Repurchase agreements are a large source of banks' low-risk assets, and we expect banks to reduce their matched book operations in response to these proposals. End of quote. Barclays' Abate highlights the following. Given inelastic demand for repo, we expect banks to increase margins to offset reduced volumes. The implications for market liquidity are potentially more severe as banks and dealers may become less willing to facilitate short position and warehouse risk. A reduction in repo activity will reduce the supply of investable assets for short-term investors, widening bid-ask spreads, and could encourage the development of riskier substitutes for collateralized borrowing. Smaller security inventories could reduce cash market liquidity. In the treasury market, these banks may become less aggressive bidders at auctions. Likewise, a reduction in repo balances will limit the market's ability to transform weaker collateral into the high-quality assets necessary to meet new margin requirements. What this means explicitly for repo volumes is nothing new and has been covered here extensively in the past, and we expect repo volumes to fall for both U.S. and foreign banks. Repo in the U.S. has already fallen 40% since its pre-crisis peak. We believe the U.S. repo market can reasonably be expected to decline 10% and possibly more across domestic and foreign banks as a result of those new rules and their proposed revisions. In fact, we believe this has already begun, although empirical evidence is difficult to find outside of discussions with money funds regarding the decline in repo availability. What the Fed and the BIS are truly concerned about, and have been for the past 4 years, is ongoing instability in the repo world and other aspects of shadow banking. The last thing the Fed and Treasury will want to do is override the TBAC on its advice to moderate collateral extraction and plow on with even more quality asset imbalances in shadow banking. And this is why, at least until the Treasury proceeds to spend itself back into drunken sailor mode, that all hopes that the Fed will monetize everything is not nailed down will have to be deferred indefinitely. And with Credit Suisse, the TBAC, JP Morgan, and Barclays all having now covered this issue, we look forward to that final liquidity guru, Citi's Matt King, to chime in on precisely this topic and make it clear just what the real considerations drive Fed's tapering logic are at this moment. In a 70% consumption economy, you don't get growth, first without jobs and the corresponding increase in confidence which leads to consumption. We explore in great detail in this month's Global Macro Tipping Point the U.S. economy, and specifically within this particular sequence. Rather than inundate you with charts, let me just show you 3 I found interesting, especially since they are mainstream, which always puts a positive spin on everything. Economic data last week revealed that the economy is plodding along at subpar pace, incapable of engendering a solid pace of living wage job creation. The Bureau of Economic Analysis estimates the U.S. economy advanced at an annualized 1.7% in the second quarter, or a lowly 1.4% over the last year. This has traditionally raised recession alarms. Since 1948, any time the year-over-year pace has fallen this low, the economy has entered recession within 3 quarters. Low wages and incomes will probably continue to stymie household spending and business investment and impede the recovery efforts. The economy's weak path is consistent with findings of the Bloomberg Orange Book and its associated Orange Book Sentiment Index, which was at 49 56.3 during the week ended August the 2nd, the 25th consecutive sub-50 reading for this particular indicator. The economy added 162,000 jobs in July, while the unemployment rate slipped a tenth of a percentage point to 7.1%. While these numbers were considered favorable by some pundits, the current pace of jobs is only half the gain registered in February, that it was 332,000. And the number of persons that work part-time because of economic reasons increased 19,000 to 8.2 million workers, the same level as in June 2012. As long as the trend rate of economic output softens, the labor market will remain weak. Even with improved headline figures, the underlying job trend remains disheartening. The number of people no longer counted in the labor force climbed by 240,000 in July to 90 million, the second highest reading of all time. The labor force participation rate slumped to 63.4%, a step away from equaling the three-decade low of 63.3% posted in March and April. The growth rate of real income remains stagnant. Of the 162,000 jobs added last month, 92.9 thousand, or 57%, were in low-wage industries of retail, that is 46.8 thousand. Food and drinking establishments, 38.4 thousand, and temporary workers, 7.7 thousand. This isn't surprising, since the level of average hourly earnings fell 0.1% in July. It's only 1.9% higher than year-ago levels. Income and wages facilitate spending, which is the fuel of economic growth, and the engine is running empty. Real disposable personal incomes adjusted for taxes and inflation fell 0.1% in June and are a mere 0.6% higher than in June 2012. The primary issue running through the economy today is that most Americans lack a sufficient wage capable of boosting spending and getting the economy operating at a desirable pace. Real consumer spending is clinging to the critical 2% pace over the last 12 months. A sub-2% pace is typically associated with recessions. The risks to economic expansion are definitely to the downside, since the slightest blow to the consumer or business sector would push growth rates of real GDP, incomes, and spending even lower, thus ensuring a recession. Just about a year ago, we questioned the demographic demand thesis for why the U.S. housing recovery itself would become self-sustaining and lead to yet another fiscal and monetary nirvana. However, while the household formation remains front and center among the Fed apologists, the sad facts are that not only is housing formation actually still falling, but as a recent Pew Research study finds, a record 21 million young adults are now living at home with their parents. Since 2007, young adults have grown increasingly likely to live at home. This is a new trend with a stunning 45-year high, 36%, that is 21 million, of 18 to 31-year-olds back with mom and pop. Household formation is falling among the young adults, period. It's a new trend. As 18 to 31-year-olds continue to be forced to move back with their parents. I can't state that strong enough. But as we warned 10 months ago, there is massively more room for this to increase. As we see in Italy, it can get considerably worse. And according to a report published on last week, almost a third of Italian adults, that is 31%, live with their parents. The highest proportion was among 18 to 21-year-olds, for whom unemployment is particularly high, with 60.7 reported living at home. So with mortgage rates up, household formation down, and the rotation from full-time to part-time jobs, we suspect the exuberance priced into a housing recovery based on growth renaissance is as unlikely as Ron Paul becoming the next Fed head. It's not going to happen. Of course, the charts above are completely irrelevant, as is all the fundamental information in a centrally planned world, as long as the one all-important chart remains, the one shown here. As it correlates, the markets correlate with what the Fed is doing as it injects more money into the primary dealers. In his latest weekly Kickstart note, Goldman Sachs strategist David Kostin says clients remain focused on one thing: monetary policy and fiscal policy. This is in spite of the fact that we're in the throes of earnings season, which one would think would be a good opportunity for clients to focus on what's going on with individual companies they invested in. Not so much. Here's what Koskin says. Profit results outside the financials sector have been lackluster, with second quarter earnings per share falling 1% on a year-over-year basis. Information technology firms have generally disappointed, and the sector has lagged, returning 4% during the past month and 10% year-to-date. In contrast, financial firms have thrived. Earnings per share soared by 34% versus second quarter 2012, and the sector has outpaced the markets, returning 8% during the past month and 27% year-to-date. Our bank's research team, and again I'm quoting Koskin here, notes that corporate loan demand is improving and pipelines are building, while construction lending to housing continues to increase and spending volume has accelerated, particularly at the high end. Although it is reporting season, recent client inquiries have not focused on corporate results. Instead, investors have sought perspective on monetary and fiscal policy risks to the equity market and the proverbial great rotation from bond to stocks. Kostin also notes in his note recently, his rotation index signals the strongest risk appetite in 5 years, as domestic equity funds have received $34 billion of inflows since the start of June versus $45 billion outflows from taxable bond funds. Since the end of the crisis, investors have been remarkably macro-focused. That obviously hasn't changed. At least now, eagerness to invest in stocks is on the rise, as evidenced by the upsurge in inflows into stock funds that Kostin is talking about. As for the Fed, not only is there plenty to talk about with regards to tapering and all that, but for the next couple of months there should be plenty of interest in who the next Fed chief will be and what kind of impact they will have on the economy. It's been an odd earnings season so far. Talking heads are replete with examples of ad hoc names that have exceeded beaten down earnings expectations, choosing to ignore the bellwether names that have missed and guided down. Data is thrown around left and right to support the arguments that stocks are cheap, to forward earnings, that growth is around the corner, that all is well in the real economy, supporting the lofty exuberance among U.S. equity markets. However, if one so chooses, this chart should give you a glimpse behind the facade of the 2013 earnings per share beat. There is one source of the elixir of life, one provider of the mother milk of stocks. S&P aggregate Q2 earnings per share is tracking 0.38 above the season start levels, around 0.8% beat, and financials account for an astounding 0.63, 63 cents of that. Still think the U.S. economy is ticking along? And by the way, most of that was on reversals of loan loss reserves. An easy thing to change. Maybe the top-down GDP expectations are onto something after all, and nobody seems to be paying attention to this chart. We have extensively covered the evolution of Q2 earnings in the U.S., where so far nearly half of 240 firms have reported and 136 on deck, from the revenue recession second consecutive decline to the over-reliance on financial firms as a sole driver of earnings per share upside, to the fact that the only reason banks are beating is the FASB 115, the unaccounting of AFS swings and the suspension of mark-to-market. In other words, no top-line growth and bottom-line upside solely due to financial balance sheet gimmicks. But what about Europe, where accounting magic is not nearly as advanced a science as it is in the U.S.? Not surprisingly, we find that of the 120 Dow Jones 600 companies reported so far, the revenue picture is about the same as in the U.S., with 58% of the companies beating the top line and 42% missing. A carbon copy of the U.S.'s 43%. But it is the earnings per share where the difference truly shines. While in the U.S., some 73% of the firms have beat, in Europe this number is only 48%. The flip side, or misses, in the U.S. it is 26%. In Europe, a majority of companies, or 51%, In brief, anyone expecting a quick and easy turnaround in Europe's corporate earnings picture will have to wait for some time. To many investors, developed markets appear healthier and stronger than they have in years. Major equity markets are rallying to record highs. Corporate credit spreads are tight versus U.S. Treasuries and getting tighter, and broad measures of volatility continue to fall to their lowest levels since 2007. This kind of news would normally point to prosperity across the real economy and call for a celebration, but prices do not always reflect reality. Moreover, the combination of high and rising valuations, low volatility, and a weakening trend in real earnings growth is a proven recipe for poor long-term returns and market instability. The Shiller PE is now at 24.4, about the same level as August 1929, higher than December 1972, higher than August 1987, but less extreme than the level of 43 that was reached in March 2000, a level that has been followed by more than 13 years of market returns within a fraction of a percent of the return on Treasury bills, and even then only by revisiting significantly overvalued levels today. The Shiller PE is presently moderately below the level of 27 at the October 2007 market peak. It's worth noting that the 2000-2001 recession is already out of the Shiller calculation. Moreover, looking closely at the data, the implied profit margin embedded in today's Shiller PE is 6.3% compared with a historical average of only about 5.3%. At normal profit margins, the current Shiller PE would be 29. While it may be impossible to accurately predict when this policy-driven market will break, history suggests it would be very reasonable for the secular bear to eventually bottom at a PE multiple between 5 and 10, opening up one of the rare wealth creation opportunities to deploy capital at truly cheap prices. Some of these technical details are rather dry, but I hope you focus on the main idea. We are not talking about the potential for a modest 20 to 30% drawdown in the S&P. If history is any indication, we're talking about the potential for a 50% peak-to-trough drawdown and 10-year average annual returns as bad as 4.4% negative, according to the chart from Cliff Asness at AQR. Such a result would fall in line with somewhat similar deleveraging periods, such as the United States experienced in the 1930s and Japan experienced in 1989. There's no way to sugarcoat it. Too much equity risk can be unproductive and even destructive in this kind of economic environment. The fact that S&P revenues are contracting for the second quarter in a row, i.e. a revenue recession, is by now well known even to CNBC. This is just as we predicted in June of last year, because in a world devoid of growth, capital expenditures, and judging by the amount of train, plane, and other crashes lately, maintenance capex as well, there can be no organic growth. What, however, may come as a surprise to the market cheerleaders who unknowingly or knowingly are merely cheering Ben Bernanke's magic bubble-blowing machine, is that the other key component of bottom-line improvement, profit margins, are not only not at record highs, contrary to what conventional wisdom may incorrectly believe, but have been consistently sliding for 3 years now. And while earnings margins are only back to June 2011 levels at 8.7%, it is the far more critical operating margin, which has tumbled in the past 2 years after peaking in Q3 2011, is now back down to 8.4%, a level not seen since mid-2010. In other words, absent aggressive levered stock buyouts, which are virtually over with rates rising once again, the S&P 500 earnings per share would now be in free fall. Don't worry though, just like in 2010, 11, and 12, there is a hockey stick for that. As Goldman Sachs' chart shows, one just needs to believe in unicorns and that maybe finally this time things will simply surge higher just because the Fed wishes them to. What is even more disturbing is that a few more quarters of contraction in margins will slide right back to the levels last seen during the past peak of 2006-2007, when companies still had millions of full-time workers they could fire or simply replace with part-time equivalents. This time around, they don't have that gross profit boosting luxury, and with interest rates once again rising, the benefits from refinancing corporate capital structures at ever lower rates are now forever gone. There has been much discussion about fund flows in domestic mutual funds in the past few weeks for one simple reason. There have been inflows into domestic mutual funds as tracked by ICI. For some reason, pundits correlate this inflow with the move higher in stocks. What remains unsaid is why there was little to no discussion of fund flows into domestic stock funds for about 90% of the time in the past 3 years. The reason is just as simple. There was no inflows. As can be seen on the chart here, there were, however, other exogenous events during this time, such as QE2, Litro 1 and 2, Draghi's whatever it takes language, and Operation Twist, of course, and then QE3, which will likely continue indefinitely, and be replaced by QE4, the second, and it is fully tapered. So what is relevant? Inflows or outflows, or whatever central banks do, you decide. It is likely that the current rotation of money from stocks into bonds is more likely a continuation of the bad investment behavior by retail investors rather than a secular shift in sentiment. Retail investors' actions are driven by emotion rather than logic. The chart here shows the investor psychology cycle of investment behavior overlaid against the S&P 500 index. The bar graph in the chart is a 3-month average of the net monthly inflows by retail investors into equity-based mutual funds. Not surprisingly, net equity inflows have turned positive at the peak of the market in 2011, just prior to the debt ceiling debacle and the current QE-driven asset inflation. While investors are indeed most likely chasing performance of the market, they also appear to be more afraid of the rally. That was what we have seen historically by storing money in cash. As article after article has been written chastising investors for not jumping into the market, the reality is that investors' trust has been broken. They still remember being told that this time was different at the peak of the markets in 2000 and 2008, and it wasn't. They also remember being told to buy and hold on all the way down during the market corrections that cost them 50% or more of their portfolios. Now that individuals have finally gotten back to even for the second time in the past decade, they are indeed taking rotating money into the market. It just happens to be in cash. But then again, after being lied to, abused, manipulated, and defrauded by Wall Street, who can really blame them? Nobody may wish to believe it, but Sean Corrigan writes, "It just might be that the U.S. economy has seen its best for this phase of the cycle." Where does that leave assets? Arguably overpriced and overbought, at least he believes. The VIX has swooped to a low, only once briefly undercut since before the last new era started to lose its luster in early 2007. As a result, Corrigan's Blue Sky Index, shown here, that is the OAX divided by the VIX, being an inverse representation of what people perceive to be the worth of buying price protection, has jumped to the upper third of the 99th percentile of the past quarter century's distribution. All those counting on a weaker dollar and rising U.S. corporate profits will likely be doubly surprised. That the U.S. trade deficit shrank to $34 billion in June is being presented as good news. The petroleum boom in the U.S. has pushed oil imports down by over $2 billion a month to $10 billion per month, and non-petroleum trade generated a deficit of $37 billion a month, down $5 billion. Slowing imports and modestly higher exports are being presented as reasons for stronger GDP growth going forward. This is nice, except nobody is talking about the negative consequences of a shrinking trade deficit on U.S. corporate profits. The financial media doesn't talk about this because it doesn't understand the connection, which is based on Triffin's paradox, a dynamic which Charles Hugh Smith and I have discussed in depth on a number of occasions. The basic idea here is that the world's reserve currencies must expand to meet the needs of global trade. Most commentators view the U.S. dollar through the prism of the domestic economy. Federal Reserve money printing increases the supply of dollars, depreciating its value, and this policy is intended to competitively devalue the dollar to increase U.S. exports. Here's the heart of the Triffin's paradox. Triffin's paradox, when one nation's fiat currency is used as the world's reserve currency, the needs of the global trading community are different from the needs of the domestic policymakers. Understood in this light, rising U.S. trade deficits in the 1990s and 2000s were required to provide enough dollars to lubricate rising global trade. Trading nations need dollars to lubricate trading and as foreign exchange reserves that bolster the value of their own currency and provide asset base for the expansion of credit within their own nation. What does a declining trade deficit mean? It means fewer dollars are being exported. The global economy is about $60 trillion, of which about 25% is the U.S. economy. Into this vast sea of trade, the U.S. exports about 400 to 500 billion in U.S. dollars via the trade export. Put into perspective, it isn't that big compared to the machine it is lubricating. That is 250 billion less than was exported in 2006. So what happens when there are fewer dollars being exported? Demand for existing dollars goes up, pushing the price of dollars up, basic supply and demand. How does a rising dollar impact U.S. corporate profits? Most large U.S. corporations already earn 60% plus of their revenues overseas in other currencies. As the dollar weakened, global corporate profits skyrocketed as earnings in euros, yen, etc. rose when stated in U.S. dollars. As the U.S. dollar strengthens, overseas profits will decline when stated in U.S. dollars. Shrinking trade deficits means fewer dollars exported into the global economy, which means demand for dollars for trade, reserves, and to pay debt denominated in dollars will face shrinking supply. That will drive the price of dollars higher. As the price of dollars rise, U.S. corporate profits will decline, and as all the goods and services sold overseas in other currencies are converted, at least for accounting purposes, into U.S. dollars. Be careful what you wish for. Shrinking trade deficits may appear to be positive for domestic economy, but they won't be positive for a stock market dependent on profits generated by global corporations who earn 50 to 60% of their revenues overseas. A rising dollar driven by declining trade deficits will reset the stock market downward along with corporate profits. All those counting on a weaker dollar and rising U.S. corporate profits will be doubly surprised. And again, I'll show you this one last chart. In spite of everything I've said, as long as I keep printing money, it'll keep on going a little more, but when it snaps, it will snap for all the reasons we just discussed. In closing, I'd like to take a moment as a reminder. Do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2013 be an outstanding investment year for you. Thank you very much for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.